In the right corner, weighing in at a net worth of $8.5 billion, activist investor Carl Icahn.
I think I might give away $1 million. I think I might give away a brand new truck. Cause I feel good, yeah I feel good. Cause I feel good, hey, I think I might take a life.
In the left corner, weighing in at a net worth of $105 billion, Time Warner's board of directors, led by CEO and chairman Dick Parson.
Hello everybody. We here at 60 Minutes would like to welcome you and thank you all for watching. We are here live with exclusive coverage of the debate. The debate will be revisiting the active investment program on Time Warner led by Mr. Carl Icahn. Present at the debate will be Mr. Icahn, Mr. Parsons, CEO and chairman of Time Warner, Mr. Wayne Pace, CFO of Time Warner, and finally, Mr. Bertson, Vice President of Investor Relations for Time Warner. For the first question of the debate, over the past few years, there's been a heated debate whether the Time Warner Corporation would be best suited as a large company or separated into smaller units. Now that we have both Mr. Parsons and Mr. Icahn here, can you guys please explain why your structure creates superior shareholder value?
Thank you. See, Time Warner's strength lies in its size. We have a unique combination of assets, which provides us with a competitive advantage in the ever-evolving media landscape. This unique combination of assets protects the company from a downturn in any one media segment, hedging itself and protecting our shareholders in the long term.
Mr. Icahn, do you have a follow-up to that?
Absolutely. Now, Mr. Parsons, we both agree that Time Warner's undervalued, but I think the way we approach things is a little bit differently. Now, as you know, I'm looking for the breakup model with 4 distinct companies. Now, by doing this, I believe the market can truly recognize the potential of each standalone company and it'll be a great benefit to shareholders. Now, after the breakup, these standalone companies can continue to acquire even smaller companies and grow individually, proving that this will be best for the shareholders. Now, you're very aware that Lazard analyzed the company and gave a great 300-plus report about how Time Warner could cut costs and expenses in about a year. I think it was around $500 million.
Time Warner refuses to consider this flavor of the day approach by selling off assets that other media companies have done just to boost share value in the short term so investors like you can make a quick buck. We're focused on the long term and providing our shareholders value for years and years to come.
Thank you, gentlemen. Now let's move on to the next question. Mr. Icahn, you stated that the best way to maximize shareholder wealth, in addition to the breakup model, would be to increase the company's stock buyback plan, as well as spinning off the cable unit. Mr. Pace, what is your take or defense on this? Mr. Icahn, also please feel free to comment after Mr. Parsons is finished.
Well, that, my friend, is interesting. See, in May of 2005, the cable revenue rose about 10% to $2.2 billion. Woo! That's what I'm talking about. Its cash flows paralleled that growth rate, increasing to $822 million. Now, here's the part others have considered a reason for carving out or spinning off this company, this cable unit. The revenues, the profit margins did not widen as investors like this guy over here wanted. I don't know, it's not our fault. This was due to higher startup costs from rollout of our full-scale digital phone services. But still, this cable unit had 372,000 digital phone subscribers at the end of the first quarter, up from 153,000 last year. And 2 months later, subscribers went up to 500,000. That's what I'm talking about. Now, see, that's all well, but we're also in the process of acquiring Adelphia, which, as you know, will expand our growth opportunity by far in new markets, which is exactly what we're trying to do to increase our shareholders' wealth. Now, for the other part of this question, before Icahn over here started his active investment program, I don't know, we had a $5 billion buyback plan in effect. Well, I completely agree. Increasing our buyback plan is better for our company and for shareholders as well. But, dude, he wants to do an instant $20 billion buyback plan. All right, it's a lot of money right out of our pockets, okay? We can't exactly handle that right now. Obviously, we have other things to use our money for. But we're taking his suggestion, obviously. We care about what our large shareholders think. And actually, all shareholders in general, I'm sorry. Didn't mean to single anyone out. Instead, in November, we decided to increase our buyback plan to $12.5 billion. Now, we will be buying back $1.4 billion a month for 3 months. From what we know of our company, buying back our shares is the best use of our capital. And since buying back shares shores up our stock price, which is obviously our main goal of our company.
Mr. Icahn, do you have anything to say to that?
Sure. These are all valid points you're making here, Wayne. But the one underlying thing I think you're missing is that the possible spin-off or equity carve-out of the cable division would completely benefit the easing of the credit constraints Time Warner is seeing. Now, I believe Lazar's report said the debt that Time Warner was carrying was around $30 billion. $30 billion. You really don't think it's a good idea?
Of course not. Of course not. Obviously, you're the one suggesting it. Why would I take that serious? But no, I still think we should keep it. Obviously, the way with our conglomerate, with the way we are set up right now, obviously you want us to split us up into 4 parts. But right now, the cable unit is 43% of our profit, which is huge. So right now, if you spin that off, that decreases the amount that we will be getting, which in turn also decreases the amount that we can actually handle to paying off that debt. So right now, the way the company is perfect. We are managing it quite well, I would have to say.
Disagree.
Or we'll just have to agree to disagree.
Gentlemen, time for our third question. Mr. Icahn, you have often criticized Time Warner of poor oversight and mismanagement. Please elaborate on this statement and why current management is not meeting shareholder interest.
Sure. Well, let me cite the biggest and best example for this case, the merger or debacle of AOL and Time Warner. Now, throughout this whole mess, the board has been a part of all the decision and all the wrong parts of what happened. Now, 12 of the 14 directors that witnessed this and were part of this are still on the board currently. Now, this is what's wrong with their conglomerate structure. It's not efficient, and by separating these companies into 4 distinct standalone entities, we can focus more and the management will completely be revamped. Now, it was my idea to replace Parson, CEO and chairman, corporate governance problem in itself, with Frank Biondi, a media veteran of Viacom and Universal Studios. What do you think about that, Dick?
Well, Carl, let's take a step back here. Myself and my management team, we've always had shareholder interest as our top priority. Ever since the merger, we've trimmed the company's debt, we sold our underperforming assets, and we settled all the regulatory and legal problems with the AOL merger. We're on the right track. We're cost cutting, and we're becoming a better company.
All right, I understand, but can you really heal a gunshot wound with a Band-Aid? The measures you're taking are in the general direction where we should be going, but still, this operation needs to be completely revamped. And that's only the first step.